On or before December 31st, you are considered single for the full year and thus cannot file a joint return. Alimony can be taxable to the recipient and deductible to the payor, while child support is neither taxable or deductible. The divorce decree is often the governing factor in determining who may claim dependency exemptions. As you can see, divorce and separation can create a multitude of tax problems. Contributions to charity are some of the most frequently overlooked tax deductions. In addition to gifts of cash, items such as used clothing or furniture are also deductible at fair market value. If you use your car for church work, scouts, or other charities, deduct 6 cents a mile. Gifts of stocks, bonds, or works of art may greatly reduce your tax burden. However, be sure you keep records to back up all claims. Here's good news for taxpayers who use credit cards for purchases. Amounts levied as finance charges on revolving charge accounts are fully deductible according to an Internal Revenue Service ruling. Simply by keeping track of these charges on your monthly statements, you may substantially reduce your tax. This tax saving is retroactive for 3 years. If you have not taken this deduction before, you may file for a refund for prior years. If you are divorced and have children from a previous marriage, and if you are remarried, amounts contributed by your new spouse for the support of your children are considered as being furnished by you in determining major supports for the children. There are various effects which this ruling has on divorced parents, and every concerned taxpayer in this situation should investigate these rules. Again this year, taxpayers have the option of filing the regular 1040 long form or the 1040A short form. Care should be used in exercising this option. The IRS has carefully stated that the short form has limitations. It does not offer the deduction advantages of the long form. Deductions such as medical expenses, charitable contributions, interest, taxes, casualty losses, child care expenses, and many others are not available to users of the short form. The long form allows for adjustments to income, such as excludable sick pay, moving expense, and employee business expense. Also lacking on the short form are valuable tax credits, including retirement income and investment credits. Before you use the short form, be sure you're not costing yourself money. Taxpayers who move from one location to another because of their job are often entitled to certain tax advantages. To qualify, you must meet the 50-mile distance and the full-time requirement. Taxpayers who qualify for the moving expense deduction may take the cost of moving to the new job and house hunting trips prior to the move within certain limits. Expenses of selling or leasing the old residence, as well as the new one, are also deductible within certain limits. If you move to a different state, you may have additional problems of how to handle moving expenses. The moving expense deduction is a welcome tax break. Remember, the reimbursement is income, and to avoid paying the tax on this, you must claim the necessary deduction. Mother Nature is sometimes responsible for creating disasters. Our tax system offers a helping hand to the victims. You may deduct the loss from a disaster occurring this year on last year's tax return, even though it has already been filed. Here's how it works. You file your 1973 tax return by April 15th. In July 1974, you suffer a casualty loss by tornado, hurricane, flood, and so forth. And the president proclaims that you're in an official disaster area. You have the option of deducting the loss on next year's tax return or on your 1973 return, even though it has already been filed. simply file an amended return. Should such a disaster occur in 1974, prior to filing your 1973 return, you may still include the loss on your 1973 tax return. If you are retired or age 65 or over, there are special tax laws which are to your advantage. One important benefit is that certain types of retirement income, such as pensions and annuities, are not completely taxable. Also, with certain qualifications, your tax may be reduced by a credit of 15% of your retirement income. This credit is doubly important because it's a direct dollar-for-dollar reduction of your tax liability. If you sell your residence for more than you paid, you may be able to exclude all of the gain. And in addition, you are entitled to a double personal exemption. These are some of the tax breaks you qualify for by being 65 years old or retired. There are many other benefits that can greatly ease your tax burden. You should seek competent tax help. The common term childcare can be misleading because the deduction for this applies not only to dependent children under age 15, but also to the care of a disabled dependent of any age. If these expenses are caused because of your job, you may deduct for the care of the dependent as well as expenses for household services such as a maid or cook. You can even deduct expenses for a day school, nursery, or care in another home. For care outside the home, the deduction can be as much as $200 a month for one child, $300 for two, and $400 for three or more. Your income level can be as much as $18,000 before limitations begin. Many taxpayers will have the benefit of an itemized deduction for child care expenses, up to a maximum of $4,800.